Welcome to Illuminati Silver. We tell the truth about silver. Today is Friday the 27th of March 2020. And yesterday evening we published our daily update entitled Market Update, Gold and Silver Rise as Dollar Falls. Plus in the last few days we published two other interesting videos. One entitled Who Said You Cannot Get Silver at Spot Price? And the other How We Bought Gold Today Below Spot as Prices Rise. And we place links to all three in the description box below. Now later this evening we shall produce another daily update, and then tomorrow our gold and silver weekly update, which will be more encompassing. But before then, with the Dow Jones up yesterday, closing up at 1,351 points or 6.4%, and the S&P 500 up 154 points or 6.2%, and the Nasdaq up 413 points or 5.6%, and Asia-Pacific markets also broadly up overnight, it is only reasonable to ask the question, are equities now on the road to recovery? Or have what we have seen these past few days a false dawn, with equities just bouncing back prior to a further and lengthy fall ahead? There are no doubt numerous experts out there telling us that this is it. We're in the midst of a global financial meltdown, and we can understand why so many people may see it that way. But contrarian investors have made their fortunes by moving against the herd. So we thought we would take a look at two articles published by Bloomberg yesterday and today, which addresses such concerns. Let's listen to what these articles have to say. The first being from an investing plus fundamentals perspective, and the second from a technical analysis point of view. Bloomberg Article dated March 26, 2020, 8:03 p.m. That's 20:03 GMT. False bottom or start of something big on this rally's stamina. In the stock market lately, only one thing is constant: speed. After falling into a bear market at the fastest rate ever, the S&P 500 just recorded its quickest three-day advance in 9 decades. As absurd as it may seem, the Dow's already started a fresh bull market, up more than 20% from the lows, after more than $2 trillion in value was created in 3 days. Is it a bear market bounce or something more sustainable? Nobody could possibly know for sure. While stocks had surely priced in a huge amount of pain, nothing compares with what's been happening recently in terms of shock to the economy. Using history as an imperfect guide, there's reason to be skeptical. It's taken stocks an average of 18 months to start to recover after first signs of an economic contraction. But with trillions of dollars of stimulus landing, the case for bottom feeding also exists. It cannot be stated enough, no precedent exists for the current situation. This week, the amount of people filing for unemployment insurance more than quadrupled the previous record. In Washington, Congress is working on passing an historic stimulus package. For every optimist who says we could be witnessing the start of something real, there's a pessimist to remind you that the largest stock rallies happen in bear markets. Here's 6 views on whether or not this epic rally will last. 1. Sentiment hasn't washed out. When Emily Rowland, the co-chief investment strategist for John Hancock Investment Management, talks to financial advisors, she still hears mixed signals. Some say their clients are petrified, while others are still fielding requests about where and when money should be put to work. The bottom will come potentially when we see sentiment completely washed out, or everybody totally selling indiscriminately and giving up, Rowland said by phone. We're not quite there yet. 2. Light at the end of the tunnel. To John Stoltzfus at Oppenheimer Asset Management, the intermittent rallies over the last few weeks are a signal of where the market really wants to go. Those rallies could be challenged by any negative news, but there's a sense of relief over the prospects for fiscal stimulus. It helps that cyclicals and small-cap stocks, for instance, are gaining, says the firm's chief investment strategist. The market is placing its vote on cyclicals and momentum and growth. It's looking towards that, he said. It does appear that there is light at the end of the tunnel, and it's likely daylight, and not a locomotive coming down upon us. 3. Timing doesn't add up. Normally a 10% market decline lasts a year, while it takes about 1.5 years to recover from a 20% drop, according to Northern Trust Wealth Management. The S&P 500 fell as much as 34%, and only a few days have passed since the bottom. Predicting exactly when the market will bottom is impossible, says Katie Nixon, the firm's chief investment officer, and investors should be wary of anyone who claims to have the answer. For risk assets, the best medicine is time, she said. Market timing is notoriously impossible to forecast, and there are too many unknowns at this point. These include, most importantly, when infection rates will begin to decline, as well as the magnitude of earnings declines, and the impact of monetary and fiscal policy measures, which is not immediate. 4. Congress went big. While reported jobless claims Thursday were worse than expected, many investors are hoping the increase will be temporary, says Chris Gaffney, president of world markets at TIAA. What's important now is that Congress pass its $2 trillion spending bill to help shore up the US economy. More economic data will likely challenge the market, but support is coming. The stimulus is definitely what investors are looking at versus those horrible weekly numbers, he said by phone. Congress went big, and I think it's worked so far for investors. 5. Absence of good news. The expectation of fiscal support is already priced into markets, and going forward there's probably going to be a void of good news, according to Lorraine Goodwin, economist and multi-asset portfolio strategist at New York Life Investments. Investors still need more clarity on the economic impact, the extent of credit risk, and assurance the market is functioning smoothly. The other things we need before we can move on as investors is addressing the root of the problem, which is at its core a medical problem. I think case numbers have yet to spike in the US, Goodwin said by phone. We're not out of the woods yet. 6. Companies haven't fundamentally changed. To Peter Jankowskis, the co-chief investment officer at Oakbrook Investments, it's reasonable to expect that badly beaten down companies would bounce back now that stimulus is in sight. As an example, he points to Chevron Corp, which saw its share price cut in half this year. There isn't fundamentally anything that's changed with that company. We've just seen a drop in demand for its product, and a very well understood reason for that drop in demand, he said. With a stimulus package on the way, it's reasonable to assume the shortfall is temporary. End of article. Bloomberg Article, 27th of March, by Joanna Ossinger. Technicals, the pros are watching after this instant bull market. US stocks' heady jump from lows just a few days ago is forcing another reassessment of key levels of market direction. The S&P 500 index's 18% gain over 3 days left it at 2,630.07 on Thursday, with those intraday lows below 2,200 on Monday, almost feeling like a distant memory. Of course, this still leaves the gauge 22% below its February 19 record high, as investors grapple with the global spread and its potential effect on everything from economic growth to financial systems. Here are some technical levels analysts and strategists are watching. Fibonacci fervor. Keep buying the rip, said Evercore ISI technical strategist Rich Ross in a note on Thursday. The powerful tactical rally to 2,800/2,945 remains intact and continues to strengthen on the back of high conviction bullish risk reversals across the likes of credit, volatility, cyclical shares, Europe and Asia. The range he cited corresponds roughly with the 50% and 61.8% Fibonacci retracement levels between the February peak and the depths earlier this week. 200-week average. The S&P 500's moving average over the past 200 weeks, now around 2,644, was a key level cited as support on the way down by the likes of Miller Tabak & Co.'s Matt Maley. Thursday's close was awfully close to it, so this one may get another look. Gain before retest. An oversold rebound can extend further over the near term to test the 2,643 to 2,664 200-week moving average and Fibonacci retracement level confluence, as well as the 2,711 to 2,741 March 12 price gap. JP Morgan Chase & Co. technical strategists Jason Hunter and Alex Tepper-Floman wrote in a note on Wednesday. A reflex rally of that magnitude, 20 to 25%, would be in line with short-term rebounds following similar price collapses in October 2008, October 1987, and October 1929, they said, but cautioned that such advances could fade and set the market up for a potential retest of the March lows. Death cross. One thing to be on alert for, of course, is a phenomenon that some say is a bearish signal, the death cross, which occurs when the 50-day moving average falls below the 200-day line. The former ended Thursday at 3,047, while the latter sits at 3,031. The cross already happened for the MSCI All Country World Index, but Sundial Capital Research Inc.'s Troy Bombardier says it may not be such a negative signal this time round. Selling on a death cross did allow you to avoid some major bear markets in the past, he said in a note on Wednesday, but since the MSCI gauge cross came after the stock market crashed, I don't think it will be very useful this time. The stock market's crash happened so quickly and the death cross came too late to protect investors. I wouldn't consider this to be a bearish factor for stocks. End of article. Well, these are both interesting, and the fact that equities have risen so strongly, primarily in our view because of the various government stimulus packages, eventually this will feed through into the markets and consumer buying. That said, of course, in fairness, both authors refer to this. It really is too early to tell, and we suspect there will be more pain before more gain. If there is one message, though, that we can take from this, and that is that the future path is uncertain and need not lead into a complete financial meltdown. Many thought 2008 would lead to this, and yet markets recovered stronger than ever. Now, whilst this could potentially reoccur on the back of extreme government borrowing and spending and debt issuance, we all know the chickens will eventually come home to roost. But it is just possible, that the can be kicked further down the road. If this happens or not, we shall all be able to at least have a good idea in the months ahead. Thank you so much for listening. If you've already subscribed to this channel, thank you. And if not, please do so. not forgetting to press the bell sign so that you're notified of future videos as and when they are published. Over on our Richard and Greg channel, we will, in a couple hours' time, publish a new update, which once again we hope and sincerely pray that you will subscribe and follow. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.